Hey everybody. Okay, another really good day, and I'm actually I'm recording this video like on a preposterously large monitor, so I'm not sure if you can see it more clearly if you have a big monitor, but try a full screen, maybe it'll help. Anyway, I just wanted to look at a few key ETFs, kind of to update us where I think the market is right now. I'm recording this just moments after the close on Monday afternoon. So here's the spider, and as I mentioned on my Tasty Treat show, there's kind of good news and bad news for the bears. The good news is that we've cut through this gap. This was the big price gap between November 9 and 10, and we punched right through that. So I'm actually going to say goodbye to this because it served its purpose, and because on Friday we closed, we'd hit a low right at the gap, and that was where we were going to like bounce up to here. No, we opened strong and then fell. So we cut through that, so yay. The not so good news is that we have these two very formidable Fibonacci retracements constituting support. And these are no small thing. One of the Fibonacci's is based upon this monster, which is all the way back to the bottom of the financial crisis. And the other is anchored to the low of the COVID crash. And it just so happens, it's kind of miraculously, we've got a pair here and a pair here. So, this might be a very sensible low for 2023 down here at 315 on the spider. But at the moment, this is what we're grappling with, this zone right here. If we can get below that, then it really just opens the gates up for selling. Channels and the channel on commodities is still very helpful. I think commodities are going to be instrumental in leading assets lower. Next goal here is to break 23.42, which is going to be very dependent upon oil. And what oil needs to do is, and we'll drag this down, be more conservative, it needs to cut through its own right triangle top that it's been working on. What else is germane? Let me see here. China, I think, is just illustrative of the kinds of waves we're seeing down. If we change this to a line chart, you can see how this has been just progressing lower, where you get these occasional national team interferences where the government orders them to buy stocks, and then it eventually abates. That cannot go on forever, of course. What else? Real estate is working its way lower. This, of course, is one of my favorite ETFs. And importantly, we broke through the same time gap, that is November 9 and 10, on IYR that we had on spiders. So that sets us up for a continued droopage on that one. Now the cubes, just as I'm worried about the spiders being right close to that pair of Fibonacci retracements, by the same token, quite concerned about the support the cubes are offering, and it's in the form of this trend line. This trend line is anchored to the bottom of the financial crisis. It's also anchored to the bottom of the COVID crash. You can see quite clearly that for a decade and a half, we've been very obediently within this channel. And what's happening recently is that, having peaked last November, it seems like a million years ago, doesn't it? But it was just a year ago. Since we peaked here at these extraordinary heights, we've been working right lower, down, up, down, up, down, up, down. And the next big test is that trend line. It is astonishing to me that we perfectly touched it. And I've mentioned this before because I was flagellating myself for not getting out. We tagged it to the penny on October 13. We got close again back in early November, around Election Day. And we're getting close to it again now. This is a key area. This whole zone right here will represent strong support. If we can break it, that really simplifies life for the noble, lovely creatures known as equity bears. It's kind of a 1-2 punch in this case too, because we have both this retracement and this supporting trend line. So what I'd love to see, of course, would be a move into this zone, and for the whole of 2023, an ultimate low way down here, basically matching the COVID crash lows. Anything else to cover? One last thing, bonds, pretty happy with how that went. I made mention that right here, pretty near the tippity top, bought TLT puts, and we've fallen nicely on this, and I think this will be an important step in yet another leg down. It would be so nice and easy if it just was just a smooth line all the way down, but it's not been. We've had these ridiculous counter-trend rallies to contend with, which have been horrible. But I think we're well past with this one now, and we can have some fun again. So that's going all right. Anyway, positions, 34 different bearish positions, all of them expiring eons from now, all of them deeply in the money, and all of them profitable. So kind of just watching and waiting at this point. Just got my arms crossed and keeping an eye on things. So that's where things stand with, I think, only 8 trading days left in the year.